We are standing at a critical turning point in the global monetary system. A new Federal Reserve chair has just entered the stage, and the ripple effects are already shaking the foundation of the precious metals market. Gold and silver are reacting not on speculation, but on expectation. Expectation of change, instability, and the return of monetary uncertainty. What comes next is not just a market move, it's a signal. When a new Federal Reserve chair steps into position, the market does not simply see a change in personality or administrative leadership. It interprets a potential shift in the entire direction of global liquidity, interest rate expectations, and ultimately the credibility of the monetary system itself. And this is where the real importance begins to unfold, because most participants in the financial system are not reacting to what is explicitly said on day one. They are reacting to what they believe will be forced, adjusted, or quietly reversed in the months ahead, and that anticipation alone begins to move capital before any official policy is even drafted or discussed in detail. The Federal Reserve Chair is not just a figurehead. It is the central signaling mechanism for the world's most influential currency system. And when that leadership changes, it creates a psychological vacuum where traders, institutions, and sovereign actors begin reassessing risk models that had previously been built on assumptions of continuity. And continuity in monetary policy is one of the most deeply embedded assumptions in modern finance, so even the slightest perceived deviation from that continuity becomes enough to alter positioning in gold and silver markets almost immediately. Gold and silver do not wait for confirmation. They respond to expectation, and expectation is built on credibility. And credibility is always tested first at the point of leadership transition, because that is when prior policy frameworks are either reinforced or subtly dismantled. Even if the language used by the incoming chair remains cautious or carefully neutral, markets read between the lines. They look at prior voting behavior, past speeches, institutional alliances, and the economic conditions inherited at the moment of transition. And from that combination, they begin constructing a forward view that may or may not align with official guidance. In the early stages of a new Federal Reserve chair's tenure, the most important factor is not what is done, but what is believed to be possible, because the range of perceived policy outcomes expands, and when that range expands, uncertainty increases, and when uncertainty increases, capital seeks safety, and historically, that safety has consistently been expressed through precious metals, particularly gold as the monetary hedge and silver as the more volatile, more responsive companion asset that tends to exaggerate the direction of the underlying monetary signal. The market begins to ask a series of questions that are rarely answered directly, such as whether interest rate policy will remain restrictive or begin to soften sooner than previously expected, whether balance sheet reduction will continue at the same pace or be slowed under economic pressure, whether inflation will be tolerated at higher levels in exchange for financial system stability, and whether political pressure will subtly influence the independence of future decisions. And none of these questions need explicit answers to move the price of gold and silver, because the mere existence of the questions is enough to shift sentiment under a new chair. The Federal Reserve is often viewed as entering a recalibration phase, even if officially it is described as continuity with adjustment, and that recalibration is where precious metals begin to respond more aggressively, because recalibration implies that prior assumptions about inflation control, liquidity withdrawal, and rate stability may no longer hold with the same certainty. And in a system built on leverage and forward pricing, uncertainty is not neutral. It is expansionary for safe haven demand. Gold, in particular, reacts first because it is the primary monetary metal in the global system, held by central banks, sovereign wealth funds, and long-term institutional allocators who are not chasing short-term gains, but are instead positioning for systemic protection. And when those actors perceive a shift in Federal Reserve tone or leadership philosophy, even if subtle, they begin adjusting reserves and hedges in ways that are not immediately visible in public data, but are reflected in price action. Silver, on the other hand, reacts with more volatility because it sits at the intersection of monetary perception and industrial demand, meaning that any monetary uncertainty introduced by a new Federal Reserve chair does not just influence investment demand for silver, It also interacts with existing supply constraints, industrial consumption trends, and forward-looking expectations about real economic activity. And this dual nature causes silver to often move more aggressively than gold once a macro narrative begins to form. What makes a leadership change at the Federal Reserve particularly significant for precious metals is not simply the individual personality involved, but the broader institutional constraints and pressures that surround the position, because no chair operates in isolation. They operate within a framework of inflation data, employment mandates, political expectations, banking system stability concerns, and global dollar demand. And when these factors are already under stress, a leadership transition becomes a focal point for all unresolved tensions in the system. Markets tend to run what they believe a new chair will be forced to do rather than what they say they intend to do. And this distinction is critical because monetary policy is often reactive in nature even when presented as proactive. And so the anticipation of reaction becomes a driving force in itself, particularly when inflation remains persistent or when debt servicing costs begin to place structural pressure on fiscal authorities, both of which are environments that historically support higher gold and silver prices. In such moments, the credibility of fiat currency is not questioned openly in mainstream discourse, but it is continuously evaluated in capital allocation decisions, and gold becomes the quiet referendum on that credibility, while silver becomes the amplified reflection of that same sentiment. And when a new Federal Reserve chair steps in, even a slight perception of policy softening or tolerance for financial system accommodation can trigger immediate repositioning in both metals. It is also important to understand that the Federal Reserve's influence extends far beyond domestic interest rates. Because the US dollar is the foundation of global trade settlement, debt issuance, and reserve management, so any perceived shift in Federal Reserve stance has global implications, and international holders of dollars, including foreign central banks, begin reassessing their exposure. And that reassessment often includes incremental increases in gold reserves as a hedge against policy unpredictability. The transition period is therefore not just a domestic event, it is a global signal event, and gold and silver are among the first assets to reflect that signal because they are universally recognized, not tied to any single sovereign liability, and historically resilient during periods of monetary transition, which is why they are often referred to as financial insurance rather than speculative instruments in serious monetary analysis. When liquidity expectations shift under a new chair, even subtly, it alters discount rates across the entire financial system, and lower perceived future rates or increased liquidity support tends to increase the present value of non-yielding assets like gold, while also increasing speculative appetite in silver due to its higher beta to macroeconomic expansion and contraction cycles. And this is where the surge often begins, not from sudden crisis, but from gradual repricing of future conditions. There is also a behavioral component that cannot be ignored because markets are driven not only by data but by narrative, and the narrative of new leadership inherently carries the possibility of change. And change in monetary policy expectations is one of the most powerful catalysts for capital rotation into hard assets, especially when prior policy regimes have already created elevated debt levels and stretched valuations in equity and bond markets. So when we observe gold and silver beginning to surge following the introduction of a new Federal Reserve chair, it is not simply a reaction to the individual, it is a reaction to the entire probability distribution of future monetary outcomes widening, and that widening alone is enough to shift global capital flows toward assets that are not dependent on central bank promises or policy consistency. In this environment, it becomes increasingly clear that precious metals are not reacting to headlines in isolation. They are reacting to structural positioning changes in the global monetary architecture, and the new Federal Reserve chair becomes the focal point through which all these structural tensions are temporarily refracted, interpreted, and priced by markets that are constantly attempting to stay one step ahead of policy reality, which is never static, never fully predictable, and always subject to the underlying constraints of debt, inflation, and confidence. That when markets are confronted with central bank uncertainty, the reaction in gold and silver is not gradual, it is immediate, And this immediacy is rooted in the structure of modern financial pricing systems that are designed to anticipate rather than wait, to discount future policy rather than respond to it after confirmation. And this is the core reason why precious metals begin to move the moment uncertainty enters the narrative around central banking decisions or leadership changes or even subtle shifts in communication tone from policymakers. The global financial system today is built on forward guidance, and forward guidance is essentially a mechanism that attempts to remove uncertainty by signaling future policy direction in advance. But the paradox is that when forward guidance itself becomes unclear, inconsistent, or open to interpretation, it creates a vacuum that markets must fill, and they fill it not with certainty, but with probability distributions of outcomes, and those probability distributions immediately begin to influence capital allocation decisions across currencies, bonds, equities, and most importantly, hard assets like gold and silver. Gold and silver are uniquely sensitive to uncertainty because they are not dependent on cash flow assumptions, they are not tied to corporate earnings, and they are not directly influenced by productivity metrics in the way equities are. Instead, they are priced primarily on trust in the monetary system, and when that trust becomes less stable due to central bank ambiguity, even if that ambiguity is minor or temporary, the repricing mechanism activates almost instantly as global participants reassess the risk premium embedded in fiat currency holdings. The reason this repricing appears instant is because of the speed and interconnectedness of modern trading systems, where algorithmic models are constantly scanning central bank statements, macroeconomic releases, and interest rate expectations, and these models are not waiting for full confirmation of policy shifts. They are reacting to changes in language intensity, tone deviation, and implied future scenarios, which means that even a subtle change in how uncertainty is expressed by a central bank can trigger large-scale reallocation into or out of precious metals within minutes or hours. But beyond algorithms, there is also a deep structural layer of human behavior that drives this reaction, because institutional investors, sovereign wealth funds, and large asset managers are not simply reacting to numbers, they are reacting to risk management frameworks that require them to adjust exposure when policy uncertainty increases. And in such frameworks, gold is treated as a primary hedge against systemic uncertainty, while silver is treated as a higher volatility extension of that hedge, meaning that silver often experiences amplified moves once gold begins to signal a shift in sentiment. Central bank uncertainty also impacts the bond market directly, and because bond yields are a key component in discounting all financial assets, any instability in yield expectations feeds into gold and silver pricing almost immediately, since gold competes with yield-bearing assets on a relative basis, and when uncertainty rises, bond volatility increases. And when bond volatility increases, the attractiveness of non-yielding but stability-preserving assets like gold rises in parallel, creating a synchronized movement across asset classes that is reflected first in metals pricing. Another critical factor is that central bank uncertainty often leads to reassessment of real interest rates, which are nominal rates adjusted for inflation expectations, and gold is historically inversely correlated with real interest rates. So when uncertainty clouds the path of inflation and monetary policy, real rate projections become unstable, and that instability is enough to trigger repricing in gold as markets attempt to anticipate whether holding cash or bonds will preserve purchasing power in the future or whether it will erode it under shifting policy conditions. Silver, in this environment, behaves even more aggressively because it is not only influenced by monetary uncertainty, but also by industrial demand expectations that are themselves sensitive to economic confidence. And when central bank uncertainty rises, it often introduces broader concerns about economic stability, which in turn affects industrial outlooks, renewable energy investment expectations, and manufacturing forecasts, all of which are deeply tied to silver consumption, meaning that silver becomes a leveraged expression of both monetary fear and economic uncertainty simultaneously. The speed of repricing is also driven by the fact that gold and silver markets are globally integrated, operating across multiple time zones and trading hubs, which means that uncertainty originating from a central bank announcement in one region is instantly transmitted across futures markets. physical demand channels and exchange traded instruments worldwide, and this creates a cascading effect where initial price movement triggers margin adjustments, hedging activity, and momentum-driven trading that further amplifies the original signal. It is also important to recognize that central bank uncertainty does not need to be extreme to trigger this response, because markets are not waiting for crisis-level signals. They are sensitive to marginal changes in confidence and even a slight deviation from expected policy language, such as a less clear commitment to inflation targeting or a more cautious tone regarding economic outlook, can be enough to alter the perceived trajectory of monetary policy, and that perceived trajectory is what drives asset pricing in real time. Another layer to consider is that global debt levels have reached such a magnitude that central banks are effectively operating within a constrained environment where every policy decision has trade-offs that affect sovereign balance sheets, banking stability, and fiscal sustainability. And when markets sense that these constraints are becoming more binding or more visible, uncertainty increases not because of ignorance, but because of recognition that policy flexibility is narrowing, and this recognition directly supports higher valuations in gold and silver. The repricing mechanism is also influenced by the fact that physical demand for gold and silver often reacts differently than paper market activity, because while futures markets can adjust instantly to uncertainty, physical markets respond to longer-term confidence shifts, and when both converge during periods of central bank uncertainty, the combined effect creates stronger directional moves, as speculative positioning aligns with real-world demand pressures. Especially in regions where currency stability is already a concern, there is also a psychological dimension where uncertainty itself becomes self-reinforcing, because once gold and silver begin to rise in response to central bank ambiguity, market participants interpret that rise as confirmation of underlying risk, which then attracts additional capital flows, creating a feedback loop where price action reinforces perception and perception reinforces price action, leading to accelerated momentum that can persist until clarity is restored or a new equilibrium is established. In addition, central bank uncertainty often leads to changes in currency expectations, particularly regarding the US dollar, which is the primary denominator for gold and silver pricing globally. And when dollar direction becomes less predictable due to uncertain policy signaling, it introduces volatility into exchange rates that further enhances the attractiveness of gold and silver as neutral stores of value not dependent on any single currency regime. This neutrality is a key reason why gold and silver respond so quickly, because they are not liabilities of any institution, they are not promises of repayment, and they are not subject to default risk in the traditional sense. So when uncertainty increases around the institutions that govern currency issuance and monetary policy, capital naturally flows toward assets that exist outside that liability structure. And this flow is not theoretical, it is structural and recurring across historical cycles. The repricing is also influenced by the fact that central banks themselves are participants in the gold market, and their reserve management decisions are often influenced by long-term assessments of currency stability, geopolitical risk, and diversification needs. So when uncertainty increases at the policy level, it also affects the behavior of these very institutions, creating a layered response where both private and public actors are adjusting exposure simultaneously. As uncertainty persists, volatility in gold and silver tends to increase, not just in direction but in amplitude, because markets begin to price in multiple potential policy paths simultaneously, and each new piece of information acts as a filter that reduces or expands those paths, causing rapid shifts in sentiment that are reflected in price swings that can appear disproportionate to the surface level news but are actually rational responses to deeper structural ambiguity over time. Repeated episodes of central bank uncertainty contribute to a broader structural revaluation of monetary trust, where gold and silver are increasingly viewed not as speculative instruments, but as essential components of risk management frameworks. And this gradual shift in perception is what underpins long-term secular trends in precious metals demand, particularly during periods where monetary policy credibility is repeatedly tested. And when all these layers are considered together, from algorithmic trading responses to institutional hedging requirements, from bond market sensitivity to real interest rate uncertainty, from industrial demand interactions to sovereign reserve adjustments, it becomes clear that the instant repricing of gold and silver is not a reaction to noise, but a reflection of a deeply interconnected system responding to the first signs of ambiguity at the center of monetary authority. And as that ambiguity widens across policy communication channels, markets begin to adjust even more aggressively, moving capital toward hard assets that have historically preserved value during cycles of uncertainty that begin with central bank language and economic calibration that eventually shapes the entire global financial structure in ways that are often only recognized in hindsight when the transition has already occurred and the new equilibrium begin to take form and the system continues to respond to signals that remain unresolved and evolving, and the system